Hey everyone, Michael Album here from Roofstock. And today I want to talk to everybody about something, if you've been following the news or reading the newspaper, you've probably been hearing a lot about, which is inflation. Let's start by talking about first what inflation is and how we can use it. And then we can actually get into discussing what are some things we as investors can do to play some defense and potentially even some offense and use inflation to our benefit. So inflation at its base definition is basically the dollar losing purchasing power over time. So if you think about what things today cost $1, if inflation was 3% or 4% or 5%, in a year from now, we wouldn't be able to purchase the same groceries for $1. They would be more expensive because our dollar would only be worth less. So in that dollar example, if you could buy a loaf of bread today for $1 and inflation was 3%, next year that same dollar would only buy 97 cents worth of bread. So it's the dollar losing value over time. And there are economists that talk a lot about why the cause of it is, what causes inflation, but we're not going to get into that during this video. You can check out the podcast we did with Jason Hartman to do a deep dive into inflation and some of its causes. But so moving forward to how we can, as investors, use inflation to our advantage. So using debt is actually a really great hedge against inflation. And I'd always heard this as I was coming up in my investing career, but I didn't really understand why or really what it meant. So what it is in effect, if you think about having a long-term mortgage, take your 30-year fixed mortgage. From the day you get it until the end of the life of that mortgage, I can tell you down to the penny what your payment's going to be because it's fixed. Every single month will be the same payment. Every single month, month in and month out. So because of the fact that it's fixed, we know exactly, again, down to the penny every single month what that payment's going to be, and it remains unchanged for the life of the loan. Now, when you think about wages or salaries, rents, those tend to go up over time. And oftentimes they'll keep up with inflation, but oftentimes they'll actually outpace inflation. And so if we have inflation at, say, 3%, and you get a 5% raise at work, you're in effect earning, your purchasing power has increased by 2% as compared to last year. And so we hope that rents continue to do the same thing. So if you think about the expenses that you have on a rental property, if we're using a mortgage, we'll have a mortgage, property taxes, insurance expenses, what have you. But if the mortgage remains fixed and your rents go up, hopefully outpacing inflation, you'll actually make more and more money over time, both on a dollar basis, but also from a cash-on-cash return perspective. So the other cool thing to think about inflation is that we are paying off debt that we borrowed today in strong dollars with future dollars, which tend to have less value. So it's kind of a complicated thing to wrap your head around, but let's talk through it again. I'm borrowing money from a bank or from a lender today, and I'm paying it off with dollars tomorrow or in the future. There's a saying that dollars today are worth more than dollars tomorrow. And so we in effect get to use cheaper, if you will, dollars to pay off this mortgage at a later date when we're borrowing those strong dollars today. So if that's confusing, I highly recommend you go give that podcast with Jason Hartman a listen to, because he does a really great job of explaining what inflation is, how to use it, and we get into the weeds a little bit more. But from a high level, just remember that if we're using debt, it's a really great hedge against inflation because we're using future dollars to pay off today's dollars that we borrowed. So I hope you enjoyed this video. Would love to hear comments, questions, concerns in the box below. And as always, look forward to seeing you on the next one. Happy investing.